Good morning or good afternoon, wherever you are in the country. Thank you for spending this time with us. My name is Keith Duran. I'm joined, as always, by Jim Warner, Director of Research and Co-Portfolio Manager. For those of you who are new with us today, Jim's going to spend some time talking about the markets and the economy. And then later in the presentation, we'll talk a little bit about the themes and the securities that we hold, which are driving the market. He's going to talk a little bit about the AI pullback. So this is a great time, particularly if you're new. This is a great time for you to get to know our process and thinking better. So we encourage you to ask questions. Which you can do, as the presentation goes on. If you think of them, just click the Q&A button at the bottom of the page. Go ahead and ask away, and then we will address those at the end of Jim's prepared remarks. So, without delay, I guess, Jim, I will turn it now over to you.
Great. Thanks, Keith. Thanks to everybody who is attending live. Yeah, and I would just echo Keith's thoughts to fire away with questions. We'll leave some time for that at the end. Okay, so what we're going to talk about is we're going to focus initially on the pullback in AI stocks that we've experienced over the last, I don't know, week to 10 days. And so we've entitled this presentation, Shaking the Taurus Out of the AI Trade. So you can tell that we remain pretty bullish on AI. So what's really been going on in the last week or so that this AI pullback has occurred? I created basically an AI composite of a bunch of AI stocks, and the chart on the right shows you how they've performed over the last few days in the blue line, and you can see that it's basically fallen. And this is a typical normal pullback. This isn't the end of the AI cycle or the AI trade. It's very common once a trade has made a lot of money to take profits, and certainly a lot of profits have been made. And so this sort of mean reversion of the outperformers, i.e. the AI stocks, kind of yielding to the underperformers is exactly what we've been seeing. So this is sort of a healthy shift as opposed to some sort of bad omen for the market as a whole. And we can see that because the other two lines on this graph, the kind of pinkish line is the energy sector, and the black line is the financials. And these are, typically the more, cyclically sensitive sectors they tend to fall first when we're really going into a bad patch in the economy. And so the fact that they outperformed and were frankly even up over this period of time is a good omen for the rest of the market and sort of the bull market being more intact. The other thing I'd mention too is that the Mag 7, which has a lot of overlap with the AI trade, a lot of the same members of it, comprise of such a large percentage of the overall index that when they're weak, kind of drags the whole index down a bit. So it's easy to, sort of extrapolate too much from essentially what has been a rotation between sectors. But in our view, the AI trade is just taking a pause, and it is really just the beginning of the trade insofar as we are starting to see the AI trade spread out across more industries, and we'll talk a bit more about that. The other narrative that you always hear whenever the market starts to pull back is, oh boy, the valuation is too expensive. And so if you look at this blue line in this chart, that's the forward PE of the S&P 500, and today it's at 25 times, which is, yes, near the highs that were reached during the dot-com boom back in 99, 2000. And so at first blush, that seems very high, and we should be concerned. But as you recall from last month, and if you didn't watch last month's webinar and you're still having concerns about whether this is 1999, go back because we spent a whole bunch of time on that. But real quick, the reason why you can get more comfortable with a 25 times PE today is because of the black line. The black line is the profit margins of the S&P 500 members in aggregate. And so what you can see is that since 1999, you've had basically this increase in profit margins a pretty dramatic one, from call it roughly 9% during the 2000s all the way up to around 14 to 15% today. And what's interesting about that is that it's very likely that these corporate margins will continue to go higher over the next year or so because you'll have potentially lower interest rates, which will be a tailwind. You'll start to see some of the cost efficiencies of AI being implemented at businesses. And I'm going to talk a bit more about that in a minute. And there are going to be other sort of tailwinds like deregulation and other sorts of stimulus that came through the big, beautiful bill. All of this could lend itself to higher profit margins. So, you know, again, if you're still worried about it, this being 1999, I suggest that you go back and you look at last month's webinar. But from our perspective, in aggregate, frankly, higher PEs are justified when you have higher profit margins, and you can see that relationship in this chart. So the AI pullback, just to touch on that real quickly, and just explore it a little bit further. We've had a couple of these already. I mean, we had the DeepSeek pullback, and then it started in January. That sparked a 23% pullback in this AI index that I created. Liberation Day obviously created a huge, broad market meltdown, which took down the AI names as well. And then the AI index increased by 107%. And so this current pullback is roughly about 8%, which is healthy, but nothing to be particularly concerned about, as a lot of the long run factors are still in place. Just to touch again on the fact that this isn't 1999, and there's another way to think about it. So on this chart, which I thought is very interesting, you see Cisco. Cisco was sort of really the poster child for the dot-com boom, which basically what happened during the dot-com boom is you had a massive build out in fiber optic cables to, essentially be able to deliver the internet. That was the big thing at the time. Unfortunately, and you saw Cisco stock, which is the blue line, really accelerate and go up a ton, but its earnings never did. In fact, its earnings ended up falling off a cliff in '01 because of all of the fiber that was laid, only 5% of it was ever used. So there was all this unused fiber. And so essentially they built way too much supply for what the demand was at the time. Now, that's the exact opposite of what's happening today. If we look at NVIDIA's stock price, for example, and their earnings, it's basically tracked each other. So in other words, NVIDIA cannot build enough chips to supply the demand for those chips. And so that's why I call this no dark GPUs. Just like there was dark fiber in '99, there's no dark GPUs today. And so I think that's why you're seeing this this support for these valuations, because they're really, frankly, being supported by this pretty dramatic earnings growth. So where I put together this slide for last month's webinar, and I just thought I would show it again in sort of the timeline of where we are in the AI development. So, and what we've done within various portfolios and to play along with this trade. And so, for example, we have, obviously, we all know about the incredible amount of CapEx spend. I'm going to touch on that in a second, that the hyperscalers are doing to train their large LLM models. We've got exposure in that through a number of different names in the portfolio that I've listed below. AI is now moving into inference, where essentially businesses are using AI for actual decisions. And we've got a number of names that are benefiting from that trend. One that I'll talk about is Micron, that we recently put that on. That has been an unbelievable winner. One that could actually do quite well in the future is Tempest, TEM. That is actually it's a company using AI for drug discovery. And that's one area that we think AI will have an enormous impact. As we move out a few years, we'll get into more physical AI. We talked about this before. This is your autonomous driving, your Meta glasses, IoT in factories and industrial applications, and then ultimately humanoids. And we've got exposure to that. And ultimately, then we'll get down the path towards quantum computing, and we already have a little bit of exposure there. So we're in the very early days of this, what I'll call AI trade. And one of the reasons for that also is that we're now starting to see the AI benefits spread into other industries. So this is not just a tech trade anymore. There are applications outside of the technology space. And I think one of the most maybe not as obvious a beneficiary of AI is the trucking industry. And so I thought I'd share this quote from the CEO of C.H. Robinson from a recent earnings call, where he said that our fleet of AI agents are not only improving our productivity and operational performance by automating tasks that free up our industry-leading talent to focus on more strategic, higher value work, but they are also enhancing the service and value we deliver to our customers and contributing to our market share gains. There's two things I want to take away from this quote that I think are important. Number one is there's a big debate right now on how many jobs AI is going to take. And I think what you're hearing here is you're not hearing the CEO saying, well, AI is allowing us to lay off a lot of talent. In fact, he's saying the opposite. He's saying that we can take our talent and have them focus on more higher value work. Take the menial tasks, that the manual labor, and automate it through AI, and a focus more on the things that actually drive value. I think that's important because I think that's a trend that we're going to see across a lot of industries. No doubt there will be some jobs lost. Just like we no longer have pools of people on typewriters, right? There's a whole history of industries that have evolved over time, and I think this AI will be no different. But there will also be this massive productivity enhancement, which, by the way, is going to also enhance margins. Going back to the profit margin conversation. The second thing I'd point out to you is that this CEO is saying that because AI is improving their product, they are gaining market share. That means higher revenues. And I think that's really important. So this isn't just a cost efficiency game. This is also growing the top line. And the reason why, and it is these two reasons why you're seeing such an insatiable demand to implement AI across virtually every industry. And it's because of this potential for such a very high ROI. So I think that's important to reflect on. And we're going to obviously see way more companies talk about this going forward. Now, some of the angst that I need to address in this current AI pullback surrounds OpenAI. So OpenAI is now the largest startup ever at a $500 billion valuation in its last round. And it looks like it's on track to reach $100 billion in revenue in a remarkably short period of time. This graph basically shows it versus names that are obviously familiar to you, and just how quickly the projections are that it will reach $100 billion. And that's important, frankly, because the OpenAI has gone and done over $1 trillion worth of deals with other companies to really build out their platform. Now they're doing this. Obviously, the bet is that the revenues, the demand will remain so high that they will be able to sell lots of services, drive revenues higher, and be able to pay for all of this. That is one of the debates that's sort of emerging. And so we'll have to keep our eye on that. But as you can see from this is the CapEx spend from the Magnificent Seven. And I pulled this, just aggregated it and pulled it back, 10 years. And you can see this remarkable increase in CapEx spending. What's a little different than about the Magnificent Seven versus, say, OpenAI is that these are all, well-established companies with massive market caps, with huge profitability. And so many of these very large CapEx bills that are being generated by Meta and Google, et cetera, are actually being paid straight out of free cash flow or cash on the balance sheet. So there is a solidity and a less dependence on capital markets for a good number of the hyperscalers. All that leads me to believe that we're still in the very early innings. And what does this all mean? As you all know, that as you build out all these data centers, they consume massive amounts of electricity. And I just think that this is a fairly interesting slide that just gives you the scope of what we're talking about, which is so mind-boggling. But OpenAI, for example, published this slide. And so I'm sure this slide exists within Meta and Google, et cetera. But they expect to go from consuming 230 megawatts of energy at the beginning of this year to 2 gigawatts by the end of this year, and then scaling all the way up to 250 gigawatts in the next 9 years by 2033, which is, who knows whether that happens or not, but that's a pretty insane ramp. Um, that would make them a larger energy consumer than all of India, and of much of Europe combined, and which is just an absolute remarkable expansion. And if even a quarter of that happens, just think about what needs to happen on the grid. And that's why we're invested in all aspects of this. Whether it's building up the grid, building up the power gen. These are really, the natural gas, the pipelines to get the gas to the natural gas turbine. All this stuff plays into the way we're investing. All right, so let me break from that. I'm happy to go back and answer questions about it. And let's talk a little bit about the economy and the Fed. Now, obviously, we have not had much economic data to talk about over the last 41 days due to the federal government shutdown. However, there are some other data points that we can refer to. And so last week we've been talking about, frankly, the ADP payroll report for quite some time now. And because honestly, it probably is more accurate than what we're getting from the government. Um, we shouldn't ignore it, is I guess my point. What you can see is that in October, uh, jobs, according to the ADP payroll report, increased by 42,000 in December, which is obviously an improvement from September, which was negative, August, which was slightly negative, and even June, which was negative. And who knows? One data point, as I always say, doesn't make a trend. But the trajectory and the trend does sort of still suggest that the labor market is weakening. And to that end, I'm sure you've seen all the news stories about Amazon and other tech companies laying off workers. A lot of this has to do with AI and robotics being implemented. And some of this has also gotten into the job cut announcements. So the Challenger Gray and Christmas report showed an acceleration of layoffs in October. And, if you're watching CNBC, they made a big deal of saying this is the worst layoff number of any October in the last 20 years. And I just think that's a silly statement. Who knows if this is a trend? Because if we look at other data, we can see from the ISM manufacturing and services PMIs, the employment component of the index, that things actually look like they're actually improving from the depths of July. And this kind of makes a little bit more sense intuitively, insofar as we had the big tariff scare in April. And we didn't know what the rules of the road were for trade. And as the trade deals have been settled, it's probably given businesses more confidence in terms of hiring. So we'll see if any of the, we'll see as we get more data, how, the government data confirms or rejects, these sorts of trends. The one thing that is worth noting is that I went back and looked at the number of employees at the Magnificent Seven firms, which are obviously there's a lot of overlap with AI. And what's really interesting is that there was an incredible amount of hiring, a quadrupling basically of employees from 2015 to about 2022. And that was basically when you saw probably a big internal investment in AI starting to pay off within these businesses. And so since then, the headcount has actually been fairly muted, if not, basically pretty flat. That's pretty interesting. Now clearly, what's been going on is some of there isn't as much of a need for the lower end coders, and perhaps some other functions have been automated as well. But you know, as AI is being implemented, it could very well impact hiring, and it may already be impacting hiring. So something worth to keep in mind. Obviously, as we think about the direction of interest rates and what the Fed's going to do. Well, the other piece that the Fed has to worry about is inflation. And while inflation is still hovering at an elevated level around 3-ish%, if you separate it out and you look more deeply into core goods and core services less shelter, our views on how the shelter data is collected. Um, but going back to the core goods, this is where you should see inflation from tariffs if there was any. And with core goods CPI up 0.3% year over year, sure doesn't look like there's a heck of a lot of inflation from tariffs. And we've been saying this now for months. That seems relatively contained. And then on the core services, it's still a little elevated. That number needs to be closer to two. Maybe the last 3 months are forming a trend downward. We don't know. We'll have to see. But I think importantly, you're not seeing the big surge from the tariffs, which means it takes a lot of the concern, in my view, away from the Fed continuing to cut rates. Because certainly they don't want to have another bout of inflation. That's the last thing they want. But the weakening labor market is likely to, make them reconsider that. But so far, the market is pretty muted in its views of what the Fed will do. Essentially, there's another meeting in December, and there's a better than average chance that the market's pricing in that the Fed will cut by 25 basis points, and then a very, very gradual cutting, basically back to a 3% neutral rate is what's in the market today over the course of 2026. Who knows what the right answer is going to be? But if we have this scenario with lower interest rates, even if it's gradual, historically speaking, you don't want to fight the Fed on this. The market will generally increase during these periods, particularly if the economy continues to grow, which it is. GDP growth has remained pretty solid throughout this. Nevertheless, this CNN fear and greed gauge has once again swung to fear. In fact, it was in extreme fear about this time last week. And it's very odd. We've remarked for a number of months now of just how pessimistic at least these survey respondents seem to be, and this gauge seems to indicate. And it really, I think, comes down to where you stand politically. We went to the University of Michigan Consumer Expectation Index, and they go out and when they go out and they publish their survey once a month. And it came back in last week at the lowest level we've seen since the index was started in 1983. It was a 50 out of basically what is about 100 index. So very low. But when you separate out by political party, it becomes a lot more interesting. So the red line is the Republicans, and they're basically pretty optimistic, pretty happy. The blue line are the Democrats, and they are in utter despair. And whether it's inflated prices, weakening job market, ICE deportations, government shutdown, who knows? But the reality is there's a huge bifurcation politically, and which leads me back to saying, and I've said this many times before, is do not let your political biases impact your investment decisions. It's very difficult to do, but if you don't let the data tell you what's going on, and instead you start to insert your political view, you will run into trouble. This year, it would have meant that you have vastly underperformed. So we don't think it's ever a good idea to insert your political bias into any investment decision. Okay, and then the last thing that I'll bring up about the economy that I think is worth paying some more attention to is that the lower income and younger consumers are getting pretty stressed. We looked at the recent earnings calls for retailers and restaurants, and there's certainly an indication that they're seeing some of this stress. Dollar General basically said on households earning less than $35,000 that more than 60% claim that they're having to sacrifice on purchasing basic necessities. Wendy's is seeing pressure. Molson Coors, the beer manufacturer, is seeing pressure on low income and Hispanic consumers. And Chipotle pointed out that their most challenged cohort is 25 to 35-year-olds. And due to maybe its unemployment, increased student loan repayments, and slower real wage growth. So if we couple these comments with the poor sentiment, with the weakening labor market, it's pretty clear that we're experiencing, or some part of the economy is experiencing what we've called a rolling recession. Now, what do I mean by that? Well, if you've been following us since COVID, basically, we have been talking about how various parts of the economy have been sort of trading off being in recession. And so it would appear that the lower end consumer is now sort of in that sort of recessionary state. Now, that does not mean that the rest of the economy will go into recession, but it certainly means that this part, we want to be careful that we don't have too much exposure, and right now we really have none, to this sector, which seems to be facing a lot of pressure. So, but something to watch. Obviously, we wouldn't want to see this spread into the middle class. That would be a greater indicator of potential recession. But so far, so good. And frankly, with there are going to be very, very large tax refunds in April. A lot of the credits that were passed through in the One Big Beautiful Bill, people are still withholding too much money. So there's a very good chance that you're going to see very robust tax refund checks go to precisely this cohort. And secondly, we may be seeing lower interest rates, right? And that will take pressure off of folks with credit card debt. It'll make it, cheaper to buy a car, et cetera, et cetera. So, going to watch this very, very closely because this also may make the Fed act more aggressively. All right, so let's move into the last piece of this webinar, which is portfolio strategy and what we're doing about all of this. First, let's talk about the upcoming catalysts. And I've separated it out into kind of two buckets, positive and negative. And this isn't just positive. There are others out there, but let's just talk about some of these things because they're top of mind. Firstly, and this is a little bit in arrears, but we've just had a very excellent earnings season. Now, a lot of that was a lot of stocks were bid up into the prints, and therefore they didn't perform great on their earnings. But effectively, the earnings themselves were excellent. The guidance was pretty good. So another solid earnings season, which suggests that things are faring pretty well. We've gotten a lot of resolution on the tariffs and trade, and there should be more to come, particularly with China, in the coming months. So we've taken some of that uncertainty off the table. The federal government shutdown is finally ending, and so that takes a bunch of uncertainty off the table. Quantitative tightening is ending. Now, for a lot of you, that probably just you don't care. But this actually is really meaningful to our portfolio in this way. What essentially the Fed has been doing since 2022 they've been trying to shrink their balance sheet. And this, in effect, has meant they've been putting a lot of pressure on mortgage-backed security prices, particularly agency mortgage-backed securities, to the point where the spread to treasuries of agency mortgage-backed securities, which, by the way, have no credit risk because they're guaranteed by the government, those spreads have been wider than investment grade. And of course, companies can go bankrupt. Obviously, investment grade are the highest quality, but there's still some level of credit risk in there. So this has been a very, very unusual situation in the mortgage-backed security market now for the better part of 2-3 years. So what this QT means is that with the Fed getting out of the way in the mortgage-backed security market, the expectation is that you will see more fixed income funds and more banks and insurance companies buying agency mortgage-backed securities, which offer a great deal right now. Now, we're there. We own mortgage-backed securities. We own mortgage REITs. So we're really excited about this near-term catalyst where they may be ending as soon as the end of this month, their QT procedures. So that's an exciting thing for us. Lower interest rates, we talked about how that's positive. There's some fiscal stimulus coming our way, deregulation. All of that investment that was promised by all those companies, $1.5 trillion worth, will start hitting, next year. So that should be a positive for the economy. We've talked about profit margins benefiting from AI efficiencies. And one last thing, tons of cash sitting on the sidelines. The amount of money, we have record levels of money market funds right now in the economy. And, a lot of folks, were thinking, well, this is great. I don't take any risk. I can get a 4-5% yield. This is terrific. Well, if the Fed keeps cutting rates down to 3%, that yield is going to barely cover inflation. So a lot of investors are going to need to do something with their cash over the course of the next 12 months, in my view. Whether that's buy stocks, buy bonds, whatever. There's a lot of cash that can come into this market still. Now, we obviously have some negative catalysts. The mayoral election in New York City was I think a big wake-up call to, um, to the nation at large in that, literally an anti-capitalist won. And if this becomes a thing, and there become more and more of folks like Mamdani out there, this could have some actual implications, not next year, but down the line. So it's very important to watch that. I think the biggest near-term thing that we need to be paying attention to is the labor market. As I said, it appears that it's getting pretty weak, and so we're going to need to keep an eye on that. So with that, we're going to get a deluge of economic data, and so we'll adjust our thoughts accordingly. So what have we been doing? Well, we've been buying this debt. We raised a lot of cash a few weeks ago in nearly all of our strategies, and largely because valuations were getting stretched, and it's just time to trim. And this week we've been buyers of this pullback, and it's not just AI that we've been buying. We've been broadening out into other industries and geographies. We've been buying some crypto, some healthcare, and are investing in Korea as well, which now makes so basically now we have investments in India, Japan, and Korea, and those are probably our favorite economies right now, globally speaking. So reasons to buy the dip. I won't go through all these because I've kind of already touched on all of these, which is essentially AI is real, the federal government is reopening. I think that's going to actually help out sentiment a bit. And then this is an interesting data point from JP Morgan. Since 1980, 5 of the best years for the S&P 500 occurred when the Fed cut rates and the economy was not in recession. So, I wouldn't want to be sitting out of this market going into next year, if that's something you're considering. And again, we've got all these other interesting things coming back. So the pullback is healthy. At the end of the day, we don't think this is being driven by some fundamental issue. This is more of a sentiment, profit-taking driven issue, which from my previous webinars, that's something that we like to buy. The one thing I do want to touch on, because we were getting we have had a great run in gold, and we're one of the few investment managers out there that really have a material investment in gold. Gold and our gold miner positions have been excellent. You can see on the chart on the right. We've owned them for a number of years. And they've been also a terrific hedge in the portfolio against what has essentially been a weaker dollar. And when gold experienced this pullback, you can see it in the chart. We got some snickering calls about our position from some folks, and which we thought was kind of funny. But the bottom line is that we think some part of your portfolio has to be in gold, because we have continued deficit spending. We have a higher and higher national debt, and there's probably going to be increasing government assistance. And so this just means that more dollars are going to get printed. And if more dollars are getting printed, and that's going to devalue the dollar, if that scenario happens, which we hope it doesn't, of course, then you're going to need gold in your portfolio as a hedge. And so, while we frankly prefer a much rosier scenario, we think it's really important to have gold in the portfolio. I'm not going to go through all the themes across all the strategies. You've heard about a lot of these, and we'll be sending out this presentation later, so feel free to go through them in detail. But let me quickly touch on the performance of our kind of 4 core strategies, and then we can take some questions. So Tilt, this is our aggressive, growth-oriented, equity-oriented portfolio, is up almost 40% gross year to date. Fantastic performance. As I mentioned, in mid-October we increased the cash to about 10.5% of the strategy or of the model, which, by the way, that's really right up there with kind of the levels that we raised during COVID or during Liberation Day. So we really did take a bunch of risk off the table, And then we started to put it back on. So we did a little bit in at the end of October, and we did a little bit on Monday. So still a lot of the same themes, but certainly happy with the way that's been going. Our moderate global vigilance moderate, sort of our flagship, also fantastic returns, up 32.7% year to date on a gross basis. Obviously terrific, couldn't be happier. Running right now at about 60% equities. Did the same thing as we did in Tilt. We trimmed a bunch of winners and mid-October to raise cash, and then have been slowly deploying it since then. So even yesterday. And our conservative strategy, very, very few changes. It's doing great. Only runs with about 26% equities, and is up 27% for the year. So, and then finally, strategic income. We actually get a lot of questions about this one. This is a substitute for buying a high yield mutual fund. Let's put it that way. So what we're shooting for is some solid yields. So here we've got yields of around 5.5, maybe slightly higher. Currently, is the dividend yield that's coming off of this portfolio. It's meant to be conservative for conservative investors, but one of the big differences between it and, say, a high yield investment is that we're not taking much in the way of credit risk. So what we're trying to avoid here is taking high yield credit risk, and so we've made sort of this alternative vehicle for that. So with that, Keith, let's go to questions.
Absolutely. Fantastic stuff. So we've got a few questions. And you may have addressed this first one. If you did, I didn't hear it, but he says, I'm starting to hear more and more about increased defaults on student loans, cars, and credit cards. Is there something to be concerned about? And then the second part of that is also, what do you think about Michael Burry's big AI short?
Yeah. Well, let me address the first one. The So what's basically been happening on credit in general is that with all of the um, postponement and credit and student loan repayments and the forgiveness, as well as all the fiscal stimulus and the checks that were sent out during kind of post-COVID, essentially defaults in credit cards and student loans and cars basically went to zero and stayed there for a number of years. And so what you've seen over the course of the last few years, couple of years, is kind of a normalization in default rates. But we are not anywhere near kind of a level that is like what you would typically see in a recession. Now we may get there, and it's a good question. But frankly, we have no exposure to really no exposure to consumer finance in any of our portfolios. So it's not a big concern for me right now. But yeah, I mean, you clearly are going to see if in fact the younger cohort is in trouble, you're going to see more and more defaults, and certainly more and more delinquencies. The other area I'd point out too that I think is really sketchy are all the buy now, pay later names. So companies like Affirm, these are loans that are taken out at the cash register that where there's no credit check. And these things also, if you default on them, they don't go in your credit score. So it's really problematic, particularly in that younger cohort. And I just, it's very hard to even size the amount of receivables outstanding or loans outstanding in the buy now, pay later, world. So it's very difficult to diagnose exactly how big the problem is. But I would generally agree with the sentiment of your question, which is that we need to it's probably going in the wrong direction.
Hmm.
As for the Michael Burry big AI short, I think we must just be short on news flow because, frankly, whatever. I mean, the one thing that equity analysts can't do very well is assess balance sheets. And so there's been this notion of the circular trade, and where and this really focuses on OpenAI. And OpenAI basically, kind of doing a deal with somebody that does a deal, with NVIDIA to buy more chips, and then they keep doing deals, and they call it a circular trade. I think it's kind of silly because what it all stems from is all the demand that I talked about. So if demand goes away, yeah, then you've got a problem, and and that would certainly be something that we'd have to address. But so far, we don't see a demand problem with AI. I think also, and I don't know all the particulars of Michael Burry's AI short, but I think he's also has a problem with the way um, GPUs are getting depreciated, and um, there's there's a I think there's a kind of a flaw in his argument. There's sort of like this weird notion that like if I buy a Blackwell today, it's worth nothing in 3 years. I think that's insane. It's not how GPUs work. It's not how business works. Um, you're going to be using these chips for an awful long time, well beyond probably the book depreciation period, which I think, some of these folks are using 7 years. I don't, frankly, I don't have a particular problem with it. I do think though, there will be a lot of depreciation that will start hitting the P&Ls of these hyperscalers and folks that are spending a lot of money like Oracle on developing AI. And we may have to shift the way we value these companies to EBITDA multiples. But it's something that we're watching and address and watching I'm certainly paying close attention to. But right now, I think that I just think this is a little bit of a pile on. There was last week there were some missteps in remarks made by Sam Altman and his CFO, and I think that this was just a well-timed short thesis that frankly is causing people to just buy the dip. But as far as I'm concerned, this pullback is more like a tempest in the teapot. It's one that should be bought. And so that's how we feel about it at this point.
Yeah. Well, negativity sells, right? So,
Yeah.
so is the pressure on lower income and younger consumers different than the last 4 years, especially given inflation hikes in 2022?
Well, I mean, yeah, I mean, to the extent that number one, they have to repay their loans. That's a whole new, monthly payment that they were avoiding for a long time. And number two, you got higher interest rates. So if you want to, if car breaks down, you got to buy a new one. It's more expensive. And if you've been living high on the hog and you have credit card debt, you've got a bigger monthly credit card bill. So yeah, for sure. I mean, it's a little bit of a one-two punch. And if you've lost your job, I mean, we've been talking to a lot of, seniors in college, and they're having a heck of a time trying to find a job. So and that could be, related to AI, or it could just be that the economy really is weakening and the labor market is, in trouble. And of course, the folks that get hit the first, get hit the earliest in any sort of, labor market issues is, the folks that are unskilled or just, very new and junior. So, I think it's obviously something we got to pay a lot of attention to, but it's certainly worse than it was 4 years ago, in my view.
Okay. And last question is, if SCOTUS rules that these, the tariffs, um, or they get reversed, what are the implications to that?
Yeah, so my understanding is that there's a bunch of other ways that they could get tariffs through. So I don't think it actually matters at all.
Mm.
Some of these tariffs are already codified. There's already codified trade deals. So really what this is it's the emergency. It's like a national security emergency based on trade deficits. And while that may or may not be constitutional. We'll see what SCOTUS says, but there are other ways to skin this cat, if you will.
Yeah, gotcha. Okie doke. Well, that looks like that's all of the questions that we have. So on behalf of everyone at Lear Investment Management, thank you for taking time out of your day. We'll be sending this presentation out. And of course, if there's anything we can do in the meantime to help, please feel free to contact us, reach out anytime. Have a great day, and we'll see you next month. after Thanksgiving.
Have a good one.
Thanks.